We often get asked about bonds and we often get asked about gold. We don't fundamentally have a problem with either. However, we tend to invest very rarely in them. Now, bonds we will use to buffer an account's volatility, and we will use it for a new client who's coming on board. We don't buy every stock on the first day. So if a client hires us, it may take us 12, 18, even 24 months to fully purchase out the stock portfolio. And in the interim, we may use some bonds for the cash they're holding. But over time, the return on the bond market is basically the inflation rate. If you look at the last 100 years, the US bond market has given you the inflation rate plus 1% in return. Well, that 1% goes to taxes, so really it's just matched the inflation rate. Gold is the same. The 100-year return on gold is the inflation rate plus 1%. Now, you can get lucky and have a decade where it does incredibly well. You can also have a decade where it does incredibly poorly. We aren't going to own an asset like that. And the other aspect of gold that for me is really problematic is it just looks at you. If you own gold, you have to buy it and then you have to sell it to make a return. It does not pay a dividend. It does not pay interest. And from the time you buy it to the time you sell it, either you have to protect it or somebody else has to. This is not an asset that works for you. It's an asset you have to trade, and while you're trading it, you have to work for it. These are not the sorts of things we are going to own here. We're looking to own assets that work for us while we own them.